Rates rose for the first time in 4 months in July, in a negative signal for the central bank and the government. Ryan Lamond is my guest this morning, CEO and co-founder of NeoVision. The top line of your notes is positioning. We have taken our profits on Japanese stock positions, so you've no skin in the Japanese game. But that's a heck of a call by Goldman Sachs that we're going to be on easy street by the Bank of Japan and get to 155 in the near term on dollar yen. Quite an aggressive call. What would it take to get dollar yen to 155?
Let me tell you what worries us. It's wages. Wages are going up in Japan. And my nightmare as an economist is the wage price spiral. And I think Japan might get into that if wages continue to rise up.
But wouldn't that bounce the Bank of Japan into quicker action than we are perhaps presuming, dare I even say it, at the risk of the wrath of Goldman's, perhaps even quicker than Goldman's think?
What if they don't? Japan hasn't seen any inflation for a very, very, very long time. So we're on uncharted territories right now, and we have conservative clients, conservative investors. So we prefer to step out, wait, see what happens, and then we can step back in. We've made some good profits on it.
The last time you were with me, you were a buyer of volatility. Has that developed?
Well, that hasn't paid off quite well. We bought into volatility a bit early. We did expect volatility to spike. It did not. We still expect it to spike. Where we are today in the US markets reminds us very much of the year 2000, unfortunately.
Really?
Oh, yes.
Aren't a lot of our tech companies more profitable? Isn't the Magnificent Seven something materially different to what it was in the year 2000?
Cisco was very profitable in the year 2000. Very profitable. It was announcing huge profits just like NVIDIA.
So am I just going to grapple with five? I mean, here's the thing. What is it that I grapple with? A paradigm shift in rates, which is higher for longer, which ultimately challenges very simple, basic dividend models and equity models. Is that my stonewall to a rally?
So the 5% discount rate is something the current generation of portfolio managers and traders has not experienced that yet. So this is uncharted territories as well for these portfolio managers. This will challenge valuations. This will challenge everything. The US stock markets today is standing on the shoulders of NVIDIA and a couple of few stocks. This is a frontier market behavior. This is not a developed market behavior. And we elect not to invest in it. We invest elsewhere, and we've made better profits than S&P 500 on Saudi and UAE only.
You say we have irrational exuberance. I'm going to get Greg the ticker for the emerging market chart, which actually is quite interesting. So it's 404. You prefer outside the US. So we've got irrational exuberance in the US. So my natural corollary to that is there's some kind of a dramatic drop in the States coming relative to, do you want to be deployed broad EM including China?
Excluding China.
There's the bullish bets. We're the most bullish, the market is the most bullish on EM since 2020.
Absolutely. So no, China, we're worried about China. Brazil, we're quite positive. We still have our positions on Brazil. We're positive Saudi, we're positive UAE, and selective a few stocks here and there. So this is our EM portfolio today.
China needs a bazooka. So says the third most read story on Top China. I listened to the finance minister, and the finance minister talks more about fiscal policy than he does about monetary policy, which caught my eye. Liu Ku. What kind of bazooka would shift the narrative to get you to engage more in China, if at all?
Well, they will have to go and give much more support than just 50% reduction in tax on stocks, stock trades. They have to go and really do some serious stimulus for us to get back again.
But what is that? You're an economist. You've seen various forms of stimulus. We've seen the traditional, build it. Nobody came. You've seen the build it. You've seen rate reductions. You've seen triple R. You've seen MLF. You've seen please don't sell any stocks.
That's what worries us. It sounds desperate. They sound desperate. This is what worries us. It's not firm. It's not the China that we've known before, that it's firm on its grounds and says, we're supporting, we're here, do not worry. It sounds very desperate. This is what worries us. I'm not going to get into numbers and statistics, etc. It's the despair that from these small actions that is worrying us on China today.
Okay, so there's a number of things that unsettle you. One is about the veracity of the upside in American equities. The China growth story is unsure in your view. Therefore, logically in my head, I'd want to be long 2-year, 5-year, and 10-year paper. I want to be long right the way along the curve. Are you more discerning and say, actually, Manus, I think duration is where I want, longer duration is where I want to be?
Absolutely. We're starting to add positions longer and longer duration because we think we have a generational entry point where interest rates are today.
You see, I get accused of being ageist when I come out with things like that. You're being very disingenuous to an entire trading community. That's what's going to be said back to you. Young traders don't know how to handle these rates. Counter that, because I don't want the IBs of aggression, but I'll throw them at you. I mean, you're saying there's a whole generation of traders out there that don't know how to trade 5% rates.
Not trade 5% rates, but discount rates were at zero. So they manage these portfolios with metrics where discount rates didn't count. Today it counts. Time value of money today is
eating away.
Grinding. It's grinding.
It's grinding. Well, there you go. You can IB Ryan if you're a young equity, bond, or FX trader out there. Show them what you got, I say. Ryan Lamond there, CEO for Neo Vision Wealth Management. My guest this morning on the markets. Be careful of the 5% discount rate. Don't trip.